A single three-digit score can decide your apartment, car loan, even your phone plan. What actually moves that number, and what turns out to matter way less than people think. You've probably seen different scores in different apps, then wondered which one lenders actually use. Short answer, many lenders use fico versions, but models and cutoffs vary by product and company. As an example, common fico versions group your data into 5 buckets, with typical weights. Payment history is the biggest chunk, then credit use, then age, with new credit and mix smaller. Why do on-time payments matter so much? They're the clearest signal you pay debts as agreed. Missed or late payments can weigh heavily in many models because they predict future risk. Next is how much of your available revolving credit you use, often called utilization. Lower utilization is generally seen as safer behavior. Maxing cards out can send riskier signals. Length of history also counts. Older accounts and a longer average age suggest steadier patterns. Opening several new lines fast can make a young file look riskier because there's less track record. Recent openings are another bucket. New accounts and hard inquiries can tug scores in the short term. It's a smaller slice than history or utilization, but many quick openings can look riskier. Soft checks, like looking at your own report or some pre-approvals, don't affect fico scores. Hard inquiries for credit applications can nudge scores for a while because they signal new borrowing. When you shop for a mortgage, auto, or student loan, models often group inquiries within a window. Newer versions use around 45 days. Some older use shorter windows, so timing varies by score version. Credit mix is a smaller factor. Having experience with different account types can help establish pattern depth. It doesn't require every type. The model looks for responsible use of what you have. Common myth: closing an old credit card helps scores. Often the opposite. Closing can raise utilization and shorten average age, which many models view as riskier. Checking your own credit is a soft pull only you see. Lenders don't count it. It appears only to you for monitoring. The act of checking doesn't reduce fico scores. Scores can disagree because models and versions weigh the same data in distinct ways. Two big families, fico and Vantage score, aim at risk prediction with different formulas and periodic updates. Lenders often choose specific fico versions by product, so one profile can land different numbers. Base fico ranges commonly run 300 to 850, but version rules and cutoffs vary across uses. A credit score estimates repayment risk. It doesn't include your income, though lenders assess income separately. So a high earner with no history can look shakier than a student who pays reliably. Models look at utilization across accounts, and often on each card. A single maxed card can raise risk flags. Lower average use shows up in many top profiles, but there's no universal magic percentage. Medical collection reporting changed. Sub $500 debts were removed from major reports in 2023. A broader 2025 federal ban was later vacated in court, leaving wider exclusions uncertain. The buckets interact. Opening credit can add mix later, yet also adds an inquiry and lowers average age now. Think in signals and trade-offs, not hacks. Model history explains why rules can feel inconsistent. Modern credit scoring took shape in 1989 when fico's general purpose score became a common benchmark. In 2006, Vantage Score launched with the nationwide bureaus as an alternative scoring approach. People ask which one counts. Both are legitimate models. Many lending decisions rely on particular fico versions. Apps may show Vantage Score or a different fico version, so the same file can yield different numbers. Vantage Score can evaluate thinner files than some fico versions, so newcomers may see a number there sooner. Either way, limited history raises uncertainty, which risk models reflect until patterns accumulate. Scores update when lenders and servicers report new information. Reporting schedules differ by company and account type, so account updates can move your number at different moments across apps and lender pools. Think of your credit report as the data set, and the score as the model's result from it. Correcting inaccurate data can shift the score because the model now sees better inputs, not a secret trick. Quick map. Timely payments and lower revolving use carry the most weight, with history, new credit, and mix supporting. With myths cleared and models mapped, we can test everyday scenarios through signals and trade-offs. Education, not advice. What happens if you open a new card? Total limit rises, so utilization math may drop. But you also add an inquiry and a younger line, which some models treat as short-term risk. Moving balances between cards can change per card utilization, even when totals barely change. Distribution matters. A single near-maxed line can look riskier than several moderate ones. Amounts owed covers loans too, but revolving utilization is a particularly strong signal in many models. Paying down installment balances helps context, yet revolving ratios usually tell the sharper risk story. Rate shopping grouping covers certain loans, like mortgages, autos, or student loans, not every product. Opening several unrelated accounts quickly stacks signals, more inquiries, and a lower average age at once. When a duplicate account gets removed, the model sees different data, and results can move. That's a data cleanup, not a hack. Models only work with what's reported. Two profiles, same income story, different histories. One thin file, one long streak of on-time payments. Models tend to favor demonstrated predictability over earnings figures because income isn't inside the score. Picture opening several store cards in a month to chase discounts and extra credit lines. New limits might be small, so utilization barely drops while inquiries and new lines stack short-term risk signals. A lender cuts your card limit, nothing else changes, yet your utilization percentage jumps. Amounts owed math reacts to available credit, so a lower limit can look riskier until balances shrink. Payment history bites hardest. One missed bill can leave a noticeable mark compared with steady on-time streaks. Because the score predicts future repayment, a slip today weighs more than a quiet month last year. Inquiry grouping for certain loans applies within a defined window. Stretch beyond it, and pools may split into separate events. Different fico versions use different windows, so timing across weeks versus days can change how grouping behaves. With only a few accounts, any single change can loom larger in the picture the model sees. Broad histories spread risk signals across more data points, so one update shifts the picture less. Seen through a lender's lens, the pattern is the product. Will this profile reliably make future payments? That predictability frame closes the gap between weird score swings and real-world decisions, useful for comparisons ahead. Same balance, different limits. Proportions, not dollars, drive many revolving use signals. A larger limit makes that balance a smaller slice. A tiny limit makes it loom larger. Consistent on-time entries build a thicker record. Long, quiet stretches add few fresh observations. Scoring algorithms weigh recorded payment events. More documented on-time payments strengthen the observed reliability pattern. If a bank increases your limit, your utilization ratio can fall, while balances stay the same. No new account is involved. The math shifts because available credit expanded. Taking an auto loan adds installment experience, a smaller mix factor in many models. It also creates a new line and a hard inquiry. Rate shopping pools may group within a window. Sparse credit files give each new data point more weight, so small changes can produce bigger swings. Broad histories dilute any one event, which helps explain gentler movement on mature profiles. Across scoring rules, one question organizes the answers. Does documented behavior indicate reliable future payments? That lens explains why similar incomes can end differently. Scores reflect risk signals, not earnings or virtue. Line up two similar paychecks but very different histories, and risk models won't treat them the same. Scoring focuses on demonstrated habits on record. Documented patterns outrank claims about capacity. A well-paid newcomer with few accounts provides little track record and several recent openings. That lean, fresh file reads as uncertainty in many versions, so early results can be modest. Meanwhile, a modest earner with long on-time streaks and low card ratios shows boring, steady reliability. Plenty of recorded payments, plus tame utilization, create a more predictable picture for risk scoring. Here's the gap explained. Payment history and revolving use typically carry more weight than smaller buckets. Income isn't an input to the score. Lenders may assess it separately, while the score reads behavior. Under this lens, the steady student-style profile can outscore the wealthy rookie with limited history. Models prize proven repayment patterns over impressive capacity because they forecast likelihood, not lifestyle. A credit score is shorthand for predictability, how likely payments arrive as agreed. That's why similar incomes can diverge. Scores reflect risk signals drawn from history, not paychecks. Bottom line, a credit score signals repayment predictability, driven most by payment history and how much credit you use, not your income. If this helped, share one thing you learned and subscribe for more clear explainers. Education only, not financial advice.